Two companies connected to the AI economy are currently trading for less than $3 per share. One is building technology used in AI-powered smart city systems. The other is developing AI platforms that analyze consumer behavior across the internet. Yet, while the AI industry is attracting hundreds of billions of dollars in investment, these companies are still trading at roughly 0.96 and about $2 per share. Now, obviously, that doesn't mean they suddenly explode. But here's the interesting part. Both operate in infrastructure layers of AI that most investors rarely talk about. Not the giant AI models, not the semiconductor giants, but the data systems feeding those technologies. And historically, this is exactly where pricing inefficiencies sometimes appear. So the real question becomes, are these just overlooked small caps? Or are they early players inside AI infrastructure that the market hasn't fully priced yet? Let's break them down. AI isn't just software anymore. It's becoming a physical infrastructure network. We're talking about smart city monitoring systems, automated traffic analytics, real-time data pipelines, AI-driven advertising platforms, intelligent surveillance networks. All of these systems require something critical: continuous data processing, and this is where the market sometimes becomes inefficient. Because most attention goes toward the companies building the AI models, while the companies managing data layers feeding those models receive far less attention. This is exactly where pricing inefficiencies can exist. It's also the type of infrastructure layer institutions often watch quietly before broader market attention arrives. Now, to be clear, this doesn't guarantee anything, but it helps explain why certain small companies operating inside AI infrastructure stacks can suddenly become relevant. And this is exactly where smaller cap opportunities tend to form. Imagine a future where every major city is powered by AI-driven traffic intelligence, cameras analyzing vehicle patterns, systems predicting congestion before it happens, AI detecting accidents instantly, and governments using this data to optimize transportation infrastructure. But here's the catch. None of that works without something fundamental: real-time visual data analytics. One small company has built technology specifically designed to turn everyday traffic cameras into AI-powered data platforms. These systems can identify license plates, analyze traffic flows, and generate large-scale data sets used for urban planning and transportation analytics. And this is where things start getting interesting. Because while the company operates inside a growing AI-enabled infrastructure category, it's still relatively unknown in the broader market. But before revealing it, there's another layer here. Because the second company we'll discuss later focuses on an entirely different AI data system. Cities across the world are increasingly investing in AI-driven smart infrastructure. Governments want automated traffic monitoring, improved road safety analytics, real-time transportation intelligence, and AI systems make this possible by processing massive amounts of visual data. Now, here's the key insight. If smart city infrastructure continues expanding, which many analysts expect over the next decade, companies that provide AI-driven traffic intelligence systems could become critical data providers. In other words, if this layer expands, companies operating inside it naturally become more relevant. And the stock itself has had an interesting journey. At one point, shares traded significantly higher during earlier smart city technology hype cycles. Then, the stock pulled back as the broader small-cap market cooled and investor attention shifted toward large-cap AI companies. Now the company trades around 0.96 per share, which raises a simple question. If AI-driven infrastructure spending continues expanding, could smaller players in this space eventually regain attention? The company generates revenue by providing AI-powered roadway intelligence systems used by government agencies and transportation departments. Its technology processes roadway video feeds and converts them into structured data, enabling analytics around traffic safety, mobility planning, and enforcement systems. In other words, it's building a data layer inside the smart transportation ecosystem. And this is where things shift. Because when you actually look at the company behind this technology, you find Wrecker Systems, ticker RECOIR, currently trading around 0.96 per share. Now obviously, this doesn't mean the stock suddenly moves tomorrow. Small-cap infrastructure companies often take time before the market fully recognizes their positioning. There are also risks here, including government contract cycles and competitive pressures. But the reason the valuation remains low may simply be that the broader market hasn't fully focused on AI-enabled transportation infrastructure yet. And timing, as always, is the key factor. Now, before we get into the second stock, here's something most people completely overlook. Even though AI demand is exploding globally, many of the infrastructure layers feeding AI systems are still experiencing delayed stock market reactions. And historically, those delayed reactions are exactly where smaller cap opportunities sometimes appear later. Which brings us to the second company. But unlike the first company, which focuses on physical infrastructure and smart cities, this second company operates in a completely different AI layer. Digital data intelligence, specifically AI systems that analyze consumer intent and predict online behavior. In other words, AI-driven advertising infrastructure. The company has built an AI platform designed to identify real-time consumer intent signals. Instead of relying purely on traditional demographic targeting, its system analyzes patterns across digital environments to determine what people are actually interested in at a given moment. That information can then help advertisers deliver more relevant campaigns. And here's why this matters. As AI becomes more integrated into digital marketing, the ability to process large-scale behavioral data becomes extremely valuable. If AI adoption continues accelerating inside advertising technology, platforms that can analyze intent signals and optimize campaign delivery could naturally become more important within the digital advertising ecosystem. Because AI doesn't just power chatbots and robotics, it's also transforming how companies understand consumer behavior online. This stock has also experienced volatility. At times in the past, shares traded noticeably higher during periods of strong ad tech interest. Then the stock pulled back along with broader small-cap technology names. Today, it trades at roughly $2 per share, which again raises the same type of question. If AI-driven advertising platforms continue expanding, could smaller players eventually regain market attention? And this is where it gets interesting, because the company behind this AI advertising technology is Inuvo Inc., ticker INUV, currently trading around $2 per share. Again, this doesn't guarantee anything. Ad tech markets can be extremely competitive, and smaller companies face real challenges scaling their platforms. But the gap between AI adoption in advertising and market attention towards smaller players may explain why companies like this remain relatively overlooked. So now we have two very different AI infrastructure stories. One focuses on physical infrastructure and smart cities. The other focuses on digital advertising intelligence. Wrecker Systems operates closer to government-level infrastructure, where adoption can take time, but contracts can be large. Inuvo operates inside the digital marketing ecosystem, where adoption cycles move faster, but competition is intense. So the real question becomes, which type of AI infrastructure benefits faster? If smart city adoption accelerates, the first company's data systems could become increasingly important. But if AI-driven digital advertising expands rapidly, the second company's technology could gain relevance sooner. This is exactly the type of decision tension investors face with early-stage infrastructure companies. And stepping back for a moment, both of these companies represent a layer of the AI ecosystem that often receives less attention. Not the models, not the chips, but the data infrastructure feeding AI systems. Historically, these types of infrastructure layers sometimes move later than the headline technologies, but when adoption accelerates, they can also move more aggressively as the market begins pricing in their role within the ecosystem. And this is exactly the layer institutions often monitor quietly. If you want to keep discovering smaller AI infrastructure companies before they reach broader market attention, make sure you stay tuned for future breakdowns. Because sometimes the most interesting opportunities exist in the layers investors overlook first.